Good morning, lads and lasses. Welcome to the Flow Show, Tuesday, 28th of January. A bit quieter this morning than it was yesterday, now that everyone's DeepSeek experts. I know exactly what's going on. Everything taken in its stride. Morning, Mr. K. How's it going?
Morning, Ryan. Yeah, DeepSeek is so 27th of January. Now we are back to tariffs. So
Yep,
forget
exactly.
about DeepSeek.
Pendulum swings again, and lots to talk about on that front. Right, it will be quiet on the China front for a while now. They're on their New Year's holiday. It officially starts tomorrow, but their markets were closed today, so why not take a day earlier? So there won't be much coming out of China for the foreseeable future in terms of things like fixes and that sort of stuff. They will be keeping an eye on markets. Don't you worry about that. But we're going to be a bit quiet, perhaps, on things unless we see Mr. Trump getting involved with stuff over there while they're on their holiday. But anyway, China's closed for, I think, about 7-8 days. I have to check that, actually. But yeah, so they'll be a bit quiet. Japan's not closed. They're powering on ahead. We had a bit of data out overnight, PPI data, which came in a little bit softer, if I can find it. Where are we? Is it even on there? No, of course not. Typical. Anyway, PPI data. Their services PPI came in year on year 2.9%. Was expected to rise to 3.2% from a prior 3%. So despite it dipping a little bit, it's still running fairly hot. So nothing for the BOJ to worry about.
Ryan, I think you need to scroll up a day to get the number.
Oh, where am I? Oh, why am I on Wednesday? Bloody hell. Have I gone the wrong way? Yes, there we go. That'll be it. That'll be it. I'm getting a day ahead of myself already. So there you go, right there. You can see it in red and black. Anyway, expectations for the next Bank of Japan hike are pointing to July, according to 56% of some economists polled by Bloomberg. That was conducted yesterday. The second most favourite month is September at 18%. 9% said it will come in June. So no one is really looking for another quick hike after the last one, as I've been saying for the past couple of weeks. They weren't going to indicate a quick hike path, and they want to get over all the wage negotiations this spring and then give them a bit of space on top. That's not to suggest that if they get data going their way, that won't push them towards another hike, but it's still going to be slowly. And as you can see from those economist expectations, they're expecting a bit of slowly as well. Now, some news that dropped this morning sent dollar yen down a bit is that sources piece again from Bloomberg saying that the government is going to allow the GPIF, which is the Government Pension Investment Fund, one of the big whales, to join JGB auctions. That means getting in to JGBs at the ground floor, which may facilitate easier access for them. Maybe they go to picking up more JGBs and maybe even bringing money back from foreign investments to put in JGBs if that becomes easier. Something to watch for the future, but it's something that Cayman's been constantly telling us about, with yields rising, that this may happen. Probably a bit too early, I think, Kay, to hear from the GPI, because we can get a bit of insight into their new fiscal year moves and what they're looking to invest in and how they're going to hedge. Do you think we might see some of that coming in?
Exactly that. We are end of January. That gives them another 2 months until the end of March and to be ready for the new fiscal year. That's my immediate thought that I had when I saw this news. It is a pretty good move because, well, I mean, for them, if they go to auction, of course, the market will know, or at least get like strong suspicions when they go with much bigger amounts to auction than or buy bigger amounts than because you will see it on the percentage of take up and things. But it does give them a bit of an advantage in not having to disclose whatever they need to do for the next 3 to 6 months or so, because typically they change investment plans every kind of 6 months. If they already change, they would always remain in a band of investment. So, for instance, local JGBs, I can imagine, has been for years and years on a lower percentage than they would usually do, seeing the negative and close to zero interest rates that they got there, and they also have given out a lot of money to handle to the likes of BlackRock as well, their foreign investments. So it has been a little bit. They had a lot of leeway, but now they would be able to how shall I call it? It's not really surprise, but handle their change in investment plans a bit more rapid than needing to go through securities companies, risking leaks and things like that. So they can do it more directly, but it is clearly a move that tells us that they are now finding levels where they judge it more interesting to get back into the local bond market, the JGB market. So I think it's all a bit rather clear. They've announced themselves. I mean, it's not new. They've announced it, but this kind of move is going to make it easier for them to step into the JGB market, and by the way, fill in a lot of the void that the Bank of Japan may leave, because they are planning to reduce their JGB buying, right? And they are already reducing.
Yeah, that was going to be my next question.
Yeah,
It's are they going to step into the breach, as we say,
yeah,
to pick up some of that as well? But
it is.
slightly
Yeah,
different. They still need the yields to make it worth their while. They're not just going to blindfoldly step into the BOJ's shoes.
no, absolutely. But they do have the ammunition to do so, and more and more. That what we need to understand here is what is important for us. It's not really, well, yes, I mean, because it has a direct effect, but imagine that they change their investment plans and go back into the local market, and we see the immediate reaction of the dollar yen. It is a bit lukewarm right now. We dropped what, 40 points or so, give and take, which is not even 0.5%. But it is something that we will be monitoring closely, because if they go back in a bigger percentage in the local JGB market, that means that they will have to repatriate a bit of money, which is clearly still put to work outside. They have been relatively big bond buyers, foreign bond buyers of late, just to keep their money rolling at 4%, 4.2%, 4.5%, instead of their own 1.5% minus hedging costs. But yeah, it's something that we need to watch closely, because I mean, just them repatriating some money should support the yen in a way. But again, it's somewhere you can trade of it right now, because there's an announcement. But be careful, because it can take another 2 to 3 months before they really are stepping in physically on the floor and go like, yeah, I'll have some of those.
Yeah, and even if they don't repatriate money, just not putting as much into foreign bonds takes a
Hmm.
bit of pressure off dollar yen as well, and the yen from weakening further, because they're not changing yen into dollars and other currencies, obviously, to invest in those countries. So it's a bit. It might be a bit of pressure off the currency as well, and again, they won't need to potentially hedge either if they're all in yen assets. So again,
Well,
that
that's the thing.
again, it's another currency, a lack of currency objective, shall we say?
Yeah, that's the second thing. That's the second thing we need to monitor, because sorry. it's okay if JGB yields are at a level where they find it interesting to reinvest in the JGB market, and don't only look at the 10-year. Right? You have to look at the 20-year, 30-year, because they are pension funds. They for them 10-year is medium term. Then 20, 30 years is even when they go in it. And if you look at the 20-year, for instance, we are nearing that 2% mark, where for them it is really starting to be interesting to get back. And I think that the 30, if I'm not mistaken, is somewhere around, is it 2.5 or so? I don't really recall. Should be 30 either.
I think I've got them in here somewhere, or maybe
Yeah,
not.
it's 2.25
Moment
right
of
now. So
truth.
add another 20, 30 BPs perhaps when if they get a good wage deal over there, and then I guess they will be very interested to get to those markets. Yeah, again, the thing is, it may have an impact here. We are seeing gradually dollar yen coming under a bit of pressure because let's not forget they are not called whales for nothing, right? I mean, if they move 1% of their holdings or 2% of their holdings, it is a heap of cash, and so we can really not underestimate what may happen there. But again, in the meantime, there's other stuff to take into account, especially what's happened last night and overnight, where we saw the dollar yen jump fiercely on the back of some potential tariffs or so.
Yeah, and it's also need to be minded that the GPIF aren't the only whale. There's a whole pod of them to use. I think that's the
Yeah,
correct term for a group of whales, a pod. And yeah, so they're not the only ones. So it can be a big mover.
yeah, with their
Right.
size, more than an ocean of whales.
Yeah, exactly. Yeah, it's a good job they stopped whaling in Japan for a certain amount of time. Anyway, over to the UK, Mr. Starmer, our Prime Minister, he thinks he's beginning to see the economy turning around. As I mentioned in the chat room, that light at the end of the tunnel might just be an oncoming steam train. They say comedy is all about timing. So just after he said that comment about the economy turning around, HSBC announced that they are looking to wind down mergers and acquisitions and equity capital market operations in Europe, the UK, and Americas. So that will mean further job cuts to come. They have been doing a bit of a restructure over the last few months, so it is a continuing story. Germany, though, they are in a deep economic crisis, according to the big industry lobby, the BDI. They see 2025 GDP coming in at minus 0.1%. That'll be the third negative in a row. So no cheery news out of Germany. Over in the US, quiet data day yesterday. We did get some home sales number. Where am I gone now? Here we go. Monday. We got new home sales yesterday coming in okay, up on expectations, up on last month. Prices as well holding up 2.1% from last year, though they were down slightly, well, down around 25 grand from last month, coming in at $427,000 as the median sale price for homes. So still up over last year, but the monthlies, coming in higher. It came in higher than last month by 25 grand. So still going okay on the price front. We had a little bit of minor data, regional data from the Dallas Fed Manufacturing Index showing a 14.1 versus 4.5 previously. So a bit better on that one. Anything a note from the auctions overnight, Kay, if you kept an eye on those?
No, not really, Ryan. No, I haven't. Sorry.
No, bit of easing on the yield front, which is obviously good news for the Treasury. And speaking of the Treasury, well, I'll start with Trump. He was out and about yesterday. He's going to give fast approval to anyone building plants for electric generation. He's going to lower corporate taxes to 15% for firms producing goods in America. He's going to plan tariffs for foreign computer chips, pharmaceuticals, steel, and other industries, and he's got those under review. Taiwan is in the crosshairs for some of that, chips and pharmaceuticals. That's part of the ongoing saga, but as mentioned earlier, Trump back on the tariff bandwagon. We had the Treasury Secretary confirmed as Scott Bessent, and during his confirmation hearing, he said he was going to push for gradual 2.5% universal tariffs. Mr. Trump wasn't happy with that. He says he wants those universal tariffs at a much higher level than 2.5%. Now, my first thought on reading that is the new Treasury Secretary already coming under fire from his boss? Are there differences of opinion that are going to be potentially troublesome, or is this just Trump playing good cop, bad cop, with Bessent coming into the job? Either way, it's yet further talk on tariffs and a universal tariff. So basically just blanket, and this 2.5% is going to scale up over time. So it will jump from 2.5 to whatever after a month, 2 months, 3 months, whatever, and keep scaling up until people come to the table or get a deal done. So as we saw, dollar yen, dollar yields as well, we are back in this tariff threat mode. It doesn't take much, just a headline, and off we go. And looking at just dollar yen, probably one of the clearest moves in that anyway. We saw dollar yen rushing up to 156, and that's turned around a bit this morning. It has given the dollar a bit of a lift elsewhere against a lot of pairs too. But we've also had a bit of recovery over this deep sea crap that went on yesterday. Despite Nvidia losing the most on record, I think it is, in terms of market value, retail investors bought a record amount of their stock during the dip, or the I won't call it a collapse, let's call it a dip on the Nvidia stock yesterday. So the dip buyers were out in force. As we said yesterday, it isn't a suggestion that the world is coming to an end, much as many people had been talking about yesterday. Seen a recovery in the Nasdaq, seen a recovery in the S&P. Whether we're out the woods or not, that remains the question, but it's looking a pretty strong bounce right now. If we just look at the Nasdaq, for example, are we over the worst of it? Most probably. Didn't take long, as it often doesn't these days, goldfish thinking. But there may still be a bit of fallout still to come in the tech sector. People have had a big shock coming to them that this deep sea could do stuff cheaper and on lesser technology, and that's probably not going to go away anytime soon. But for now, looks like we might be over the worst of it. Whether we go all the way back up to those prior highs remains the question. S&P, as mentioned, pretty strong bounce from there. That's it on the news front anyway. Kane, has you got anything else?
No, not really, Ryan. I think you've covered covered everything.
Good. Right, we shall crack on then. Right, so that's it. The S&P, we're back up this level. We pinged around it before, this 60s, 30s area. Been in and on-off support and resistance point. If we do go up, we're probably going to be having another look at these highs at the least, maybe even going through them again. We had a little fake out last week. I did try a little buy stop, which got put to the sword yesterday. Well, actually got lucky and got put to the sword Friday evening, because then I avoided the gap open on Monday. That's a little bit of luck there, but you can't keep a good stock market down. So I wouldn't be surprised if we go on up here. If we find resistance there again, then I might think about another attempt at a break trade if we start doing the whole building up pressure move again. But let's see what happens later on in the US. Euro dollar, that's been playing nicely with the technical levels. We had the dip yesterday to 104.50. The decent bounce took us right up above 105 again, but we nailed the top of the zone. and this is my bigger area. This 104.50 turned into a decent area. This one, the 105, is bigger, 105, 105.30. So as soon as we hit these bigger hurdles, and we've had it all the way up, hitting these hurdles, we've done the same again. And now we've gone back below 104.50, and we're looking like we might be starting to resist into that as well. Just a little bit of tapping on the door and failing, and then holding below. So we haven't turned around this overall trend, not by any way, shape or form. So that is still in play, and the prospect of moving higher is still possible. But we need to see what happens with the dips here. Below 104, getting below some of these lows, then that picture might be changing somewhat. And maybe we're going to be looking a bit lower. Then we can focus on this zone again. A lot of people focus on the 103.50 area. I've got it as just a bit of a zone here. Call it 103, 30s, 40s, up to 60s. If we're breaking through there, then things might be turning the corner and we're heading back down. Because overall, on the longer term, we're starting to try and break this area or turn around this phase of the trend, but we're not quite doing it, and we're still nowhere near breaking the wider trend as well. So at the moment, people might be looking at this as a bit of a bear flag developing. Either way, it's still a bit of a coin toss as to what we're really going to do long term. Obviously, Fed and ECB this week could be a bit of a decider what we do on that. If we hold some of these levels again over the Fed and ECB, then we can probably move on and see what it wants to do after that. My early ECB thoughts is I think there might be a growing risk of another bum fight amongst the governing council members as to whether a lot of them want to continue cutting. Some of them are starting to waver. We've had Hawke Holtzman, who has backed the cuts thus far, but he's flipped his light switch and gone full on hawkish again. So I think we might be edging towards a point where some in the ECB are going to start talking about maybe going on pause. So we'll have to see if that starts getting reflected in Lagarde's tone of speech and what she tells us about during that. So that's just one thing I'm getting a bit twitchy about. If the ECB might be heading towards a pause, that's going to make the downside for the euro a little bit tougher. But we'll wait and see for that. Euro sterling, that's continuing its pullback from those highs. We're now back under the zone here as well. 84.20 at the top resisting. Now we're below 84. I don't often like short-term fibs, and I don't particularly like short-term fibs in this pair, but as it's a bit of a slow burner, I've lobbed this one in as it's coming up to just over a month's worth of data. We're pulling back close to it. We're trying to hold under this 84-80s area at the moment, which has been a bit of an on-off level going back. Otherwise, it's back to the old levels. Yep.
Yeah. While you're on euro sterling, can you have a bit small, wider look? Yeah. Like even going back to like August. On the 4 hours should be fine. You should have it. I have to adjust it. Go back to there. You know, we had this sharp rally there from July in August, 2024. This sharp rally, and now this one has been more gradual. If you go to today, but I'm getting small vibes there. Then that we could have a remake of this.
Yeah, it's absolutely
possible.
Sharp
rally higher, and then gradually, it's all losing steam again, because I can't really find a reason why euro sterling as such would start to go back down, but it really looks like if we are in this similar kind of vibe there as we had in August.
Yeah, well, that was all election stuff and the new government coming in. This is all the new government budget and all that sort of stuff from Reeves and her stuff. So this has not been euro led. And while you're off, I've been saying this quite a lot. You can't watch cable for what's going on in the UK, but you can watch this for what's going on in the UK. This has been all about the pound, not the euro. because we've seen yields easing off a bit, and that's why this has come down. It's given Reeves a bit of a fiscal headroom back. I think the market is half looking towards her speech tomorrow as well, again, because we are seeing the pound holding up a bit better, even in cable versus all the Trump news. So I think this pound weakness that we've seen has potentially run its course. But I don't know. It'd be nice if we get all the way back down towards the 82s. We didn't quite get up to that 85 zone that I would have liked to have tapped for a short. But you know what Euro sterling is like. It will go sideways forever. But I wouldn't be surprised if the market likes what she's selling tomorrow and we head back down maybe to the low 83s. And then we take it from there. And then obviously ECB this week, Bank of England next week, and that's a whole different kettle of fish. But yeah, this is still the pound moving, not the euro moving, in my opinion. Don't know if you've got any other thoughts, Kay?
No, true. I was just watching those two moves and the similarity that we have. Even the start, as a hesitant start back in July somewhere, hesitant start, a little bit bouncing. Same here that we saw in December, and then you have the acceleration in August. Here we have the acceleration in Jan, but it looks extremely similar. So does feel to me that may not be the end of this cross, and we may actually see a move back down to the lows if Reeves doesn't mess up and euro. Let's face it, the eurozone is not out of the woods by any means, and you just spoke about this what is it, the institute in Germany saying that Germany is still in a deep crisis. So it feels to me like this could unfold to be a pretty similar move. We saw then.
Yeah, absolutely. And we could have a similar move where we come down here and then carry on going through, because the wider trend is still quite a long downtrend. So we're not breaking it at all. But that's 2 years worth of moves here. So that's euro sterling.
Yeah, it's not the one. Yeah, it's not the one where you just pick some levels intraday and then just hammer them. I think this euro sterling is one that you have to look at a little bit longer term, like several days or a few weeks in trading. You don't step in and out of a euro sterling in an intraday. Really, it's too slow across, but it's also a cross that sometimes can keep on going with the usual hiccups. And that's just I was just looking at that picture this morning, and I said, like, wow, this is like a virtually perfect overlay of the move. So which may mean that you have like a little hiccup perhaps coming. Could be over ECB, Bank of England, Reeves, and then go back down. It does look extremely similar to me.
Yeah, and that's trading for you. Trading's all about patterns, and if you can spot those patterns, then you have a half a chance of being able to ride them if it does go. But I would have liked to have got up there into that zone for a short. I would have been happy to sit on that for a while and see where it goes. But anyway, can't go backwards. Right, let's move on. Have a quick look at Aussie dollar. That again, we had a little bust up above this area. Now we're back below it. Probably got to do all the hard work again. Headlines aside, of course, depending on what Mr. Trump is saying. So again, this is looking just dead cattish still, based on the trend that we've had down, which has been pretty sharp. I'm still in the Aussie Kiwi. That's in a bit of a grind phase at the moment as well. As you can see, we're doing a bit of sideways action. And again, as we've been saying, if you want to keep out of the Trump noise, the dollar noise, then looking at your crosses is the way forward. Yes, they move slower, but that's the benefit of having lower volatility. It just gives you a bit of time to maneuver as well. You're not so much going to get really big spikes. They're going to happen few and far between compared to the likes of dollar yen and whatnot. So the 111 gate, shall we call it, is still solid up there, but nothing's really changing unless we're under these areas 10, 110, 20-ish, 15, 20-ish, and then the 110 level. But I'm happy to stay on the short side of this one. I'd like another little dip if possible, just to maybe take a bit off the table. Then I would think about maybe adding back in the rallies as well. What's the time? Right, let's have a quick look at what you guys are talking about. Ali, what are you up to?
Dollar Schweiz.
Is what?
Dollar Swiss. I can have a look at the Swissy if you want.
Yeah, go ahead, mate. Let me bang it over to you then.
Yeah. I think, and while I'm taking over, I think what we still and the overnight moves have again proven that we can't really hang on. And we were talking about that yesterday, actually, very briefly, that you can't talk about trend reversals or new trends starting in, especially in the FX market at least, for as long as we don't have like certainty about what's going to happen in the United States, as we saw again overnight. I mean, any tariff news and the market reverses again what it was doing the day before. So this is really a market where we have to wait for clarity. So the what we are saying in the chat room is still like I mean if you are in a good position, you really need to take at least partial profits because the next day may be the complete opposite of what was happening the day before. And coming back from a bit of time off yesterday, me included, I thought that, oh, okay, I mean, not tariffs, no decision yet, and everything is going all fine and dandy. Dollar a bit offer. Then we wake up this morning and it's the other way around. So I mean, this thing that I've been talking about, we still need to pay close attention to what happens every day. So that means that we cannot like bank on positions unless you have like a really long-term view and you're already in a position that you want to run for ages. That's kind of fine, but for those who trade this day in day out, try to pick try to find those intraday moves or so. We need to really remain extremely flexible in what we are doing. Because the next day can see a 180 degrees turnaround all the time, especially when you look at those ranges. Ali, your dollar Swiss, you were saying about
Just
this.
before you start,
Yeah.
okay, just before you start, there's someone mentioned Zeus or any of the other Greek gods because I see a certain Mr. Kurdy in the chat. Happy New Year, Kurdy.
Woohoo! Hello, Curdy. How are you doing, my friend? Kalimera.
He's once a decade appearance.
Kalispera in your time zone. It's already Kalispera. The Greek gods are the son of the Greek gods is amongst us, guys. I mean, welcome, Curdy.
From great in Germany, yeah.
Yeah. Well, I hope you have your 30-year position still on. You must be long Turkish lira yen, right? Okay. All right. Well, still, it's already afternoon where you are. So yeah, Ali, the dollar Swiss, I think here the 93 quarters, bit of a resistance here. It looks to be developing a bit of a flag, but look at how fast this thing. Yesterday, I thought this move here through 90 was relatively significant, but you see, as I said, the reversals of what's happening on the day-to-day moves has been very sharp. And we're already back to what I would call kind of resistance. We're not too far from there, right? We are trading around 90.65. So this is about your little zone. If that breaks, I think we may have a look at 91.10 again before reassessing what goes on here. If it caps, well, yeah, you may try to yeah, I see what you mean about the 55 DMA 55 average there, but I'm having problems with moving averages tighter than on the daily, you know. But anyway, it overlays quite perfectly with this small flag. But look at this move and this could just be a bull flag, you know. If it breaks above, I think we may be relatively quickly back up to 91, 91s, and why not 91 and a half? But yeah, whatever you want to trade, it's perhaps worth a little try, but keep it tight, I would say. Um, let's go back to this yen, and I just wanted yesterday. I said 153 three quarters, and we tagged it. Okay, we tagged it, and from then we bounced. I didn't think we would have the strength to go above 155, but Trump and Besant decided otherwise. But look, we stopped right around 156, which Ryan already highlighted. I think that's your level now to watch. Watch for more comments on those whales. But as Ryan and I have been already discussing, they are in the preparation to and to do something, but it's probably something that is going to happen in the new fiscal year. That's kind of the timeline that I would be looking at. They've got 2 months of preparations. It is not, and especially not in Japan. I mean, in Japan is going to be something. If you decide something, it's not happening the day after, because in Japan it needs to get through a lot of admin, and anything you do over there needs to get through a lot of admin. So I guess the timeline for the start of the new fiscal year is pretty okay. In the meantime, it has reacted on those tariffs. So now we have to look, now we have to monitor to see if Trump, Besant, the combination of all the Trump hawks will take this even the 2.5%. But if they do, also slap tariffs on Japan, be careful, because we could have like a big run in dollar yen, because Japan is not going to be the country to counter tariff, well, not in my opinion at least, to start counter tariffing the US. But in turn, as we have already seen, that the Japanese company wanting to buy US steel, the chip making companies, and I think the heavy machinery, they won't be far behind. They will continue to invest in the US to be in the good grace of Trump. So, and if you say investing in the US when you're in Japan, that means that dollar yen, they may actually need to buy dollars before even we can consider this GPIF thing really coming into effect. So I would be a bit careful, trade the levels, but I would be a bit careful with this tariff thing before even thinking about the GPIF. That's what I wanted to say. So let's get back onto gold and silver. You know what? Yesterday I told you to be a bit careful with what was happening, because if you look at how anti-inflationary, I'm not going to say completely deflationary, because we don't know what's going to happen with all this AI stuff yet, but gold being being an inflation hedge trade. This started to come off yesterday, and it bounces off technical levels. Yeah, 27.35, 27 and a quarter. It is a level, and tariffs. If you take back the tariff now narrative, it could be that gold had found or has found a bit of a support here, and will start to range trade 27.60, 27.30, 25. I think that may be, until we see a bit more clarity, could be your new range. All in all, we are still correcting at very lofty levels, okay? So the big picture hasn't changed. To me, the big picture hasn't changed and won't change unless we get back below 2600. That's really my longer medium-term picture, 2590, 2600. As long as we are above, to me, this is still bullish, okay? But in the meantime, if the market judges that it doesn't need that much of an inflation hedge anymore, we could see some more corrections. This is how I look at it. And silver, yesterday I warned a little bit. I didn't find it very positive. Now we're turning around, actually. We're turning right on this level here, low 30s. We had a look below. That was a bit the risk that I saw yesterday. I'm still my very long-term opinion hasn't changed, but same as in gold, we need to be a bit careful when we talk about long-term, because being long-term metals is also costing some funding, and so I've reduced as I walked back in yesterday. and see if we can get down to cheaper levels before reinstating. If we break above 31, then I think we can see a fresh impulse and silver go higher. But until then, I'm not going to add to existing longs right now. What else do you guys look at? Sterling CAD. Wow, Sterling CAD. Do I even have it here? Sterling CAD. Oh, you're long from 175. There is. That's an absolutely great trade. Yeah, it was a very good entry around that prior low. Look, it's still barring that spike here below. It's still in an uptrend, right? This is still in an uptrend. Canadian dollar will be directed by what's going to happen on the tariffs versus Canada, and we have an important date coming up, right? Because Trump said that he would that it's possible that from the 1st of February he will slap tariffs on Canada. So we have two things coming up. The Bank of Canada this week, and then the 1st of February. It's not a deadline, but let's say a bit of a calendar line, which is going to decide upon what's going to happen in Canada. So every Canadian cross will be affected by all this, correct? So yeah, but for the time being, it's okay. And if you go back to what the discussion that we had about the euro sterling, to judge some euro, some sterling weakness or strength, sterling is getting back. I mean, if you look at this euro sterling, it has dropped a percent from the highs, right? By the way, we had this overshoot here, but it still seems like this trend line here is still coming into play here as well. So we went down a percent, so that also will have influenced your sterling Canada. Sterling isn't dead yet. And then Euro Swiss. Well, we are still kind of holding the trend is a big word, but the bounce, the weaker bounce. We had those tests earlier in January, and the trend line is holding right now. But also, I said before, I think leaving is that 94.80, 95.10 will be an area that we watch, and we stopped right there. So that's your top side zone here. That 94.80, 95.10. If that goes, we can expect more Swiss weakness in my opinion. Okay, so and if you look at that dollar Swiss, what I was showing before, just on a pure technical basis, if we start to break above 93 quarters, 90, 80, it is looking quite big again. So I wouldn't be surprised this goes for a retest up here. But in the meantime, it is finding beats on even smaller setbacks here now. Okay, so yeah, long euro Swiss for me is I'll go really long euro Swiss if I see a European revival. Then euro Swiss is probably going to go reaching for parity again. But until then, this is just one that I'm monitoring right now. And I think with that, Ryan, I mean that's good enough for me for today. Back over to you, mate.
Thank you very much, mate. Good stuff as always. Yeah, I like the cut your jib, Michael. Buy stock through 95, 10, 15, something like that. Could be a bit of a move if we break that level. It's quite a decent one. Right, we'll call it a day for today. Thank you very much, everybody, for coming to the Flow Show as always. Have a great day ahead, and we'll catch you light and breezy tomorrow. Have a good one.